Hi everyone, I'm Sangeeta Kanwar, Department of Economics, the Bhopal School of Social Sciences. Today, we are going to study about financial markets. So what are financial markets? Financial markets, they provide an avenue of sale and purchase of any kind of financial asset. It could be bond, it could be derivative, it could be government securities as well. So industries or let's say businesses, they approach financial markets to get funds for their further expansions, whereas the investors approach these markets to multiply their funds, whatever they have already. In the financial markets, which all are the institutions that interact? Firstly, we have our depository institutions. Depository institutions are the ones which accept deposits from the lenders or the ones who have surplus funds and lend it to the individual who are in deficit or they require money for their future expansion. Whereas the second type of institutions, they are non-depository institutions. They simply serve as an intermediary between the savers and the borrowers rather than accepting deposits from their lenders. So which all institutions in India can we term as depository institutions? Firstly, they are the commercial banks. Second, the savings and loan associations. Then you have mutual savings banks and cooperative credit societies. All of them, they accept deposits. Whereas coming to your non-depository institutions, they are mutual funds, insurance companies, pension funds, brokerage firms and venture capital firms. They act as an intermediary between your lender and borrower but do not accept any deposits. So if there are financial markets in an economy, what is the purpose of having a financial market? Or what are the functions that a financial market performs in an economy? Let's have a look. First and foremost, these financial markets provide a common platform where your investor and borrower can interact. Secondly, it provides a pricing information. Since your borrower and your investor can interact, it gives out a proper price determination for a particular security. Thirdly, it provides a security in the dealing of financial securities since it's a formal structure. Next, financial markets provide liquidity for the one who's holding any kind of financial security. If he wants to encash its financial security, he or she can approach financial market and sell off their respective financial security for cash. Next, all these transactions can be done at a very bare minimum cost, as well as the required information is also provided by these financial markets. Lastly, it is nothing but a channel through which we can accumulate the resources that are surplus in the economy and lend it to them who are scarce in those funds, maybe for expansion of their businesses or establishing their own businesses. Now let's see how this financial market works. In the yellow box, you have your lenders in the economy who have surplus funds and they want to invest these funds in the proper securities. In the blue box, you have your borrowers. These borrowers need money for their projects, their businesses. They can simply approach each other or interact with each other in the financial market directly. In case they do that directly through a financial market, we term it as direct finance. Or what they can do is, they can approach their financial intermediary and then this financial intermediary can subsequently match the lenders with the borrowers. If financial intermediary method is being used, that time we call this finance to be an indirect finance. So in an economy with diverse securities, there can't be one single financial market that can operate. There are different types of financial markets operating in any economy. So we can classify these financial markets on the basis of certain criteria. So it could be on the basis of, let's say, maturity of the claim or nature of claim, time of delivery or organizational structure. Let's see one by one what are these markets on the basis of different criteria. If we classify financial markets on the basis of maturity of claim, we can classify it into two formats. First is your capital markets. Capital markets are the ones which trade, or let's say promote trade in terms of medium term or long term securities. In this, since the duration of the security is medium or long term, it provides fixed and working capital of any industry. Second is your money market. Money market transact in your short-term securities. They are close substitute of money. That's why they are highly liquid and easily marketable. Next, if we classify financial markets on the basis of nature of claim, we have two types of markets. First is your equity market and second is your debt market. In the equity market, we trade in equity instruments. Now, these instruments or securities are the ones which provide a claim on the earnings or the assets of the corporation. Whereas in case of debt market, the trade happens in terms of debt instruments. These debt instruments provide fixed return to the instrument holder without any claim for any earning or asset of the corporation. Coming to the criteria of timing of delivery, we have cash market and future market. Cash market is the place where you transact at that very moment. The lender and the borrower meet and exchange their securities at that point of sale. Whereas in case of future market, it is the futures that are being traded. Futures are nothing but the contracts that lock in the future delivery of a commodity or security at a predetermined price and a predetermined date. Lastly, if we talk of organizational structure, then we have exchange traded markets and over-the-counter markets. Under exchange traded markets, these are the standardized contracts that are being traded in the exchange traded market. These contracts are being designed by the exchange itself. There is no scope of negotiations. Whereas in the over-the-counter markets, the dealers are connected through computer and telephonic link. They can transact with each other through computers or telephones and agree on a mutually agreed terms and conditions for that security. Generally, dealers here are either two financial institutions or a financial institution and its corporate client. Today, we studied a little bit about financial markets. We understood what is a financial market, what are the different institutions operating in the financial markets, what are the functions or what is the need of any financial market in an economy, and also different types of financial markets on the basis of different criteria. Thank you.